Thanks so much for tuning into this broadcast. The case for a chat with our guest today. I really want to ask him if rate cuts, potential rate cuts, if they come, or the festive cheer, can it spur the sluggish growth scenario? Because it is starting to look, at the margin, a bit worrying. Can DII flows sustain the nifty rally? They have done that thus far. The heavy lifting has been done by domestic flows. Can it actually take it further to what some people would say egregious valuations? Also, while PSUs had a fantastic 2023, the second half of 2024 has been anything but great. Do PSUs have investable pockets, or is it a wait and watch? To talk about all of this and more, Vetri Subramaniam, Chief Investment Officer, UTI Asset Management Company, with us on the show. Vetri, so good having you. Thanks so much for taking the time out.
Always nice to talk with you, Neeraj.
Thank you so much. Vetri, I want to start with a million, billion, trillion-dollar question. A lot of bulls have been mentioning that we are closer to the Fed easing cycle, and that by itself, at large, should be constructive for risk assets. The overhang from the US elections will also go away in November, and assuming it's a market-favoring verdict, there are multiple cues which might actually spur risk assets further. Do you agree, or is it not as simple as this?
Well, I think, the broad perspective that, yes, we may have seen a peak in the rate cycle in the US is certainly good for the economy. But as far as risk assets are concerned, I would actually submit that it looks like, the risk assets have already climbed that wall of worry. Because remember, it was way back in 2021 when we started to deal, with the prospect of significantly higher rates. And that did trouble the markets for almost about a year, or maybe slightly less than a year. But markets stopped responding to rate hikes even towards the end of the rate hike cycle. And if anything, they've actually powered to not just new price highs, but also significantly higher valuation levels in the expectation of rates starting to go down at some point of time. So I would actually say the rate cut cycle is pretty much in the price. I'm not sure there is any scope at this point of time to suggest that because rates go down, you will further see assets getting marked up. Why? Because it's already happened. The market is already looking forward. It's already factored this.
So in which case, Vetri, assuming that the economies, both West, China, and to an extent we are starting to see good growth. Moody's has upgraded India growth, but telltale signs from auto companies, etc., seem to suggest that there is a bit of not a growth scare really, but a wrinkle on the banana peel, if you will, kind of a scenario emerging. What do equities by and large do when growth is not quite there, but there is an easing cycle? So we've rallied. Do we correct, or do we maintain those levels and valuations?
There are many elements to the question you're asking, Neeraj. And first of all, I would say it is not even clear that we are in a synchronized growth cycle across the world.
True.
China has been having its own issues, and their growth cycle is currently completely disconnected with whatever is happening in other parts of the world. I would also submit that if you look at India, maybe because of the policy mix that we used, the fiscal conservative, not very aggressive on the monetary side, our growth cycle came out, and it has sort of held up at a reasonable level, very different from what's happened in the West, where excessive monetary and fiscal stimulus is causing them to have to deal with the ill winds which have been caused by those set of policies. So this is a very desynchronized growth cycle across the world. I'm not sure I would, look at, let's say, very simplistically, either the rate hike cycle which followed going back to 2001, where you saw a synchronized growth cycle and a rate cycle across the world. Neither is this a crisis period like post-pandemic where rate cycles and growth cycles were coordinated. So my submission would be you've got to maybe look at each market very differently, because the combination of policies and the position in the rate cycle is different. I think as far as India India is concerned, our view has been that the rate cycle will be slow in terms of cuts. It will be limited. And in fact, the governor's continued focus on keeping core at, not core, but headline at 4% suggests that we should hold our horses as far as rate cuts in India are concerned. We at best expect 1 to 2 rate cuts through the rest of the year, all the way up to March 2025. So in India, the case for rate cuts is quite limited, just given the policy framework that's being laid out.
Got it. But okay, so actually what I meant to say was that because the West and China are reeling under some growth pressures and India too has come off a little bit, that plus the view that you just expressed specifically about the Indian growth, but I mean, that and the Indian rate cycle, wherein it might be shallower and maybe later than what the Fed does, what happens to equities then? They've climbed the wall of worry. Do they stay high, aloft? Or do you see a sense of a corrective move coming? Because people have been talking about a correction, waiting for a correction. It's not coming.
Well, to call a correction is virtually impossible.
Yeah.
That's been experience over the last 30 years. But what is always true, Neeraj, is that forward returns are very often correlated, certainly at a market level, to your starting point in terms of valuations. So my suggestion to people would be that rather than focus on what will cause a correction to come, when will the correction come, there is a simple way to get past this. Focus on what is within your control. What is within your control is your asset allocation. If your asset allocation relative to your goals, relative to your risk appetite is excessive in terms of equity, not because of any excessive risk you took, simply that equities have delivered spectacular returns, very healthy returns over the last 2 to 3 years, then adjust your asset allocation. There is no point getting into this speculation about when will the correction come, why will it come. I've been doing it for 30 years now, and nobody can forecast this stuff with any degree of accuracy. And I've always said this, valuations are not like a school bell, right? Because school bells have a certainty associated with them. When they ring in the morning, you assemble at school. When they ring in the evening, you disperse from school. Valuations tell you there is risk in the market or there is a low level of risk in the market, but they are not a school bell. But it is up to you to arrange your affairs and take care of them by adjusting your asset allocation. And that is what I would encourage people to do. I think beyond a point, the speculation about why correction, who will buy, when will the flows come, this is all, beyond the point.
Have you guys taken any cash calls, Vetri? Just trying to understand.
Good question, Neeraj. In the pure equity funds, we don't take cash calls. Typically our cash levels are, 2 to 5%. It's still very well within that range. But of course, we do run certain asset allocation strategies where we take the responsibility for asset allocation, right? So in a range of between 20% equity to 80% equity or 30 to 90%, depending on the strategy, we are currently at about 45% equity, which means it's less than the neutral weight that we could have towards equity. So in a way, our asset allocation model is currently underweight equity relative to the midpoint that we could have. And that's largely driven by the fact that forward outcomes at an asset class level have not been very favorable for equities from this starting point in terms of valuations. To be fair, the model has been saying this for many months now. A year ago, we used to be at almost 65% equity allocation. It's continuously dropped as valuations have moved higher to about 45% today. So that's the message from asset allocation, and that is what I would encourage investors to look at.
Got it. Okay. I was trying to understand what would, to your mind, be the right asset allocation framework. By the way, you're giving us some fantastic acronyms, I must say, from Tina to Tara. I remember in 2023, independent of how you said it worked out, or today, that valuations are not like school bells. Pretty interesting stuff, Vetri. Okay. I want to move to some specifics, Vetri. A couple of sell-side notes that have come out in the last few days and the bank credit growth data that has come out seems to suggest some pain out there, maybe for growth at large, but definitely for credit growth. Now, I've heard extreme calls as well, wherein some very large marquee fund managers, not mutual fund managers, but portfolio managers, PMS side, who are not necessarily, benchmark per se, are saying that our exposure to private banks or PSU banks is at the lowest that it's ever been, because the credit growth cycle doesn't look too appealing, never mind the fact that the valuations are attractive. How do you look at credit growth in general and private banks in particular currently?
Sure. Well, interesting question. We actually just opened a NFO for an index fund which only invests in private banks.
Oh, okay.
And I've spoken about this earlier as well. If there is one sector where we have comfort in terms of valuations, it is actually the entire banking and financial services space in general. This is one of the few sectors in the market, and thankfully it's also a large sector in the market. So we can put money to work in this area because here we have valuation comfort. Well, is credit growth slowing? Of course it is, but I would also submit that it had been very high. Remember, nominal GDP growth, even if you look at the release which came out for GDP growth, nominal GDP growth is currently below 10% in the economy. So in the context of nominal growth being below 10%, a 13 to 14% credit growth is quite comfortable. Remember, RBI itself has been, sort of tackling some parts of the economy or some segments of lending where it had been growing very rapidly. They've actually tried to get people to pull back on that. So there is both an impact of slightly slower growth in the economy as well as actions by RBI which are causing this credit growth to come in slower than where it was a year ago. But I don't see that as anything more than cyclical. And I would actually submit that if credit growth were to turn down significantly, we would have a lot more to worry about because that would be an indicator of significantly slower growth. And significantly slower growth is going to hurt the areas which are priced for growth rather than an area which is not priced for growth. So, my investing philosophy for many years, Neeraj, has always been that cheap valuations or attractive valuations are a function of the market being unable to look beyond current data, but that is where the opportunity is. The opportunity is not where the market perceives the future to be bright and blue skies, and then it's already priced to perfection in those areas. So it's a question of how you think about investing. There are issues in banking, but I'm happy that there are because it's giving me that opportunity to get invested in an area where I have valuation comfort.
Okay, so valuations attract you enough for you to even launch a scheme to that effect. So which is interesting to know. I'm guessing you're not. You will yourself say that you're not timing it in the sense that it will start turning from a particular quarter. At some point of time, it will, and you will be prepared for it. Something like that.
Yeah, fair point, Neeraj. I don't think any of us can call inflection points to a T. Again, the school bell analogy is very apt over there. But in fact, interestingly, we just launched two strategies, both in the index fund space, which I would say are both out of favor at the current point of time. One is the private bank index, where we think the fundamentals of the banks are very healthy, and at the same time, valuations are attractive and below long-term average. The second strategy that we launched is again an index fund, but this is a factor-based strategy, which is actually the Nifty 200 Quality 30 strategy, which means that it selects companies which essentially are identified with quality, which means these are high ROE companies, these are companies with low EPS variability, and these are companies with low debt to equity. Now, if you think about quality as a factor, Neeraj, if I go back 5 years, it was all about how quality was the only way to invest and value was an outright disaster. 19 to 24 has been phenomenal outperformance by value, and particularly in the last 2 years, value has crushed quality. But again, for that very same reason, we do think that this is an attractive point to start increasing the allocation towards quality, and that's why we've launched the Nifty 200 Quality 30 strategy. So is there an element of timing? Perhaps there is, but I'm not going to say this is the moment. But I think the window over the next 6 to 12 months is great, both for the private banking strategy as well as for the quality. And these are two index funds people might find interesting to just diversify their risk in their portfolio, particularly given the composition of what has done very well over the past 2 to 5 years.
Got it. Okay. The other aspect is consumption. Now, a lot of funds and a lot of data flow seems to suggest that people are buying the last 1.5, 2 years of underperformance of staples, other consumer names, again in the hope that at some point of time, government spurred or otherwise, consumption will see a bit of a comeback. Plus, on a theory of relativity to the past, valuations seem okay. Do you concur here, or is that argument not good enough? Because it's not been good enough in the last 12 months per se.
Sure. I'd say it's a little bit of a relative argument, and maybe it echoes back to what I said earlier about quality index, because remember, a lot of those quality companies tend to come from things like consumer and staples businesses. But specifically talking about consumer staples and discretionary, look, we know that post-pandemic, companies which were selling more to high-end consumers have done far better. But, staples has been a little bit of a pain point. Also, discretionary, while it came out of the pandemic extremely strong, has been very sluggish over the last 2 years. So to my mind, in consumer, the opportunity is more relative. It is more defensive. I think in staples, you will see a little bit of an uptick, because beyond the point, how much can people actually cut back on staples expenditure? You can't. So I do think the outlook for staples is slightly better. And particularly if we see a good, sort of agricultural upturn, the portents for that are still not very great, because global agricultural prices are actually quite weak at this point of time. But if we do see a bit of an uptick over there, then I think staples can give you a little bit of a surprise. But I would not expect it to be very dramatic, because these are middling in terms of their growth prospects, and they will not change dramatically because it is staples by definition.
Okay. Vetri, the other aspect is on consumption, which might see a bit of a spurt due to rural coming back, due to festivities, or themes benefiting out of this consumption. I mean, restaurant companies or restaurants are not quite benefiting, but a Zomato is, a Swiggy is, or travel portals are doing very well consistently with hotels also. Maybe at some point of time, hotels, because of the base effect, see a bit of a pause, but these guys might continue because tourism is alive and kicking. Just trying to understand, how do you think about this discretionary consumption space?
There are pockets which have done well, Neeraj, but again, I would say, maybe there's a little bit of rotation just in terms of what the consumer is spending on, and some of the trends you're talking about relate to that. But overall, I would say consumption growth has been slightly disappointing. We're just starting to look at some of the auto numbers as they come through for the current, for the month gone by. And they're not too exciting, and they're suggesting that at the margin, trends in terms of consumer discretionary are not particularly great. You may have one or two companies doing exceptionally well, but at a sector level, I would not call this out as a sector which is, particularly, attractive in terms of a change in underlying trend growth rates. And, it's funny that you mentioned travel and, discretionary spend. At least in the US, if you look at some of the data that's come out in company calls over the last quarter, they're actually calling out a significant slowdown in both air travel as well as travel spending in general. So I wonder if we'll start to see echoes of that in India as well. Remember, the big element for travel has actually been pricing, but we've seen this in the past as well. If you use the pricing lever very aggressively, at some point the volumes itself then start to sort of come under pressure. So I do start to worry that this might be something you'll see in the travel sector as well in the near future.
Got it. Okay, the other aspect is, how do you think about what could happen to some of the themes which have been touted to be multi-year themes, because the government has made promises at global forums, let's say about climate change, this whole and therefore power, or this whole policy about defense, which had gone quiet for the last 3-4 months, maybe because of the election season otherwise, but the order books are brimming, as are the valuations, of course, but the order books are brimming. So I'm just trying to understand, what do you think of some of these pet themes in the new 5-year term or the third 5-year term of the NDA? The stocks have rallied, the sectors have done very well. Is there more steam left on a multi-year basis, or should people limit their exposures there?
Sure. Well, first of all, I think if you're thinking multi-year and you've got valuations which are in fairly aggressive level. I don't think we can think of this in terms of the tenure of governments, right? I mean, I think your investing landscape and your investing horizon has to be much longer than that to be able to take calls on businesses which are, already building in significant growth runway. Again, Neeraj, I've just been around for way too long. We've seen how IT companies got priced to the roof in 99, 2000. And this is a great lesson and a humbling experiment for all of us, because has the sector become significantly larger than what it was in 99, 2000? Remember, IT services today is larger than India's, oil imports, right? That's how large that sector has become. But if you bought some of these stocks at the inflated valuations that they existed at that point in 99, 2000, you've had, 20 years of regret in terms of the kind of forward returns that you earned out of them. I could go back to 2005, 2008, the madness that went on in infrastructure, and India will always be short of infrastructure, so on and so forth. And once again, you find that the promise and the delivery in terms of returns very, very different. So I've learned the hard way. There can be individual companies that will completely surprise you in terms of their growth prospects over 10 years, 20 years, and 30 years. But when the sector as a whole is incapable of distinguishing between individual companies, their managements, their strategies, and their ability to navigate challenges, to me, that is a warning sign. And therefore, when I see sectors which in their collective entirety start to get richly valued, the alarm bells actually go off for me. Very much the opposite of what I spoke about when I was talking about the private banks earlier. When you see collectively all companies being painted with the same brush, either positively or negatively, my instinctive reaction is to start thinking the opposite direction.
So is there an exception to this rule, Vetri? I mean, sure, I buy your point completely because that's your style. I'm just trying to think, are there pockets wherein the valuations may be expensive, but either the management commentary plus the growth landscape plus the quality and the texture of the growth and the return ratios make you think that even if these are expensive, you may want to stay invested?
Well, let's get one thing out of the way, Neeraj. Management commentary is entirely pro-cyclical, right? So if you're going to rely on management commentary, I think, I'll leave it to your, good senses, but 30 years, my experience is management commentary is entirely pro-cyclical. So please don't base, 10 years and 20 years of outcome based on management commentary. What you must base your thoughts on is the management's ability to run a company on very sound fundamentals, cash flow generation, return on capital, and the strength of their capital allocation framework. That is what navigates companies over 20 to 30 years, not their commentary about what will happen in 20 to 30 years. I mean, who has seen 20 to 30 years? And the future is, always full of surprises, Neeraj.
Wow. You don't often hear this, and therefore it's great to hear this, Vetri. Thanks for putting it out there. And yes, in some sense, very, very logical. But okay, Vetri, so my final question, and correct me if I'm wrong, but you seem, if not bearish, I'm not using the term bearish, but you seem concerned about pockets of valuations in a lot of sectors, right? By the fact that you're launching a banking index, you are constructive there, but that's a large pocket as well. A lot of our viewership is also retail, who might be investing into your funds, but who also want to try and understand what pockets or what themes from the smaller end might look attractive to a large investor like you. Is there anything out there?
Nothing that I can call out top down, Neeraj. I think it's more sort of stock specific at this point of time. And I must admit, as you go down the market capitalization curve, actually stock picking becomes harder, because that is where in general there has been a lot more valuation updrift. And I would just say we can choose terms like bullish, bearish, etc. They don't mean anything. I think as investors, our priority needs to be risk management at all points of time. When risk is being underpriced, you become more cautious. When risk is being overpriced and valuations are cheap is when you start to get more bolder. And I think this is one of those times where risk is getting underpriced. Investors just need to incorporate that into their framework. Doesn't matter whether you're institutional or whether you're an individual retail investor. Be more cautious, be more aware of risk is really the message that I would want to give.
Okay. Well, lots of gems in this conversation today, Vetri. Thank you so much for taking the time out and speaking to us. We are in September, but we are closer to the festive season, Vetri. So maybe not the once a quarter thing, but maybe slightly earlier than that, around the festive season, would be a good time to reconnect for sure.
Look forward to that, Neeraj.
Thank you so much. And viewers, thanks for tuning in to what I feel has been a really special conversation. Thanks for tuning in.